Today, we'd like to talk about the Core CPE Price Index. I think the Core CPI Price Index is actually a very important index that is, we call it the Fed's favorite. Inflation measures rose 4.9% in April, in a sign that price increase could be slowing. So the Core Personal Consumption Expenditure Price Index, the Fed's preferred inflation gauge, which is actually excluding energy and food, because energy and food, as you know, has been greatly affected by the Russia-Ukraine war and all that. So they are looking at basically other things. So rose 4.9% from a year ago. So basically rose just 0.2%, a sharp reduction from March, 0.9% increase, which is this is a month-to-month basis, and this is a year-to-year basis. And it also says that the personal income only rose slightly than expected. So this is to show that but spending beats estimate as consumer tapped savings. Basically, they're digging into their savings, and but income hasn't actually rise much. This could be actually related to wages. So the PCE price index, they are actually pretty important thing. I just give it a bit, especially when you want to talk about the inflation fears and whether the near to mid-term period inflation will continue to be a fear factor or maybe not. So a measure of prices that people living in the United States or those buying on their behalf, you can skip that, pay for goods and services. It's sometimes called the Core PCE price index, because two categories that can have price swings, especially relevant now, food and energy, are left out to make the underlying inflation easier to compute. So other things that I think are really important, as you can see, the Nasdaq has had quite a decent rebound on let me see just a second, Thursday and Friday, especially after the Thursday's meeting, which is somewhere here. So you can see the market has rebounded. Of course, the Thursday's Fed minutes meeting is basically to make the path clear ahead, which is basically to raise another 0.5% for another 2 times, to go near to 2%, which was the expected interest rates that they wanted to go up to. And US government has always encouraged 2% inflation, which is good for the country. Not all inflations are bad, so take note of that. So as you can see, 11,500 has gone up 600 points to 12,131. So is the pain over, or are we at a bear market rally, or is this really a risk-on rally, of a turnaround rally? So let's see. So I'm not sure whether I have the time today to talk about the jobless claims, and just to show you a little bit about this video, which I think is really important. Second. Internet's a bit down today. Okay, so all right, let's go here.
Last breaking news before the Memorial Day holiday weekend: advanced goods trade balance expected at a minus 114 billion, comes in light. That's a good thing. Minus 105.9 billion. Just so you understand, last month at 127 billion was the biggest ever. So we know why GDP is down. That's one of the reasons. More imports than exports. Retail inventories up 0.7%. That's definitely much less than we were expecting. And inventory building seemed to have peaked in the fourth quarter of last year. Wholesale inventories up 0.4%, very close to the up 0.5% that we.
Yeah, take note when they talk about the wholesale imports and all that have gotten less. Consumer demand also have dropped, especially in not services but actual consumer items or consumer discretionary items. That's also actually very good for the supply chain crisis that's going on. Let's continue.
We were looking for, excuse me, that's up 2.1 on wholesale inventories, up 2.1. That is as expected. Personal income is up 0.4%. That's a little bit light, and in the rearview mirror, up 0.5%. So we see that the income side's a little light. What about spending? We all know that spending's been more difficult with inflation. Spending expected up 0.8, comes in as expected, a little richer, up 0.9% with a revision of 1.4 versus 1.1 last month. If we look at real spending adjusted for inflation, it's up 0.7%. Now, let's get into the most important aspect. As Mike pointed, the deflators give us a preferred measurement of inflationary pressures. The month-over-month number, up 0.2%, up 0.9 in the rearview mirror. That was a 17-year high. If we look at year-over-year, up 6.3. That's coming off of 6.6, which was the highest since 1982.
So basically, if you can see right now, the core CPE index, as I mentioned before, it is the Fed's preferred gauge. Show that actually inflation actually peaked in March and is working its way down in April. And as you can see, the wholesale import data also has shown that there is less import and the inventory. They call it inventory. I can't remember the name. Peak in the fourth quarter as well, and then first quarter also dropping down. This is very important for the shipping sector, especially for the ports and all that on the supply chain crisis. So things are overall looking good. So this could be the sign of all these new good catalysts coming up, because all this bad news, so to say, is actually good for the market. If you know what I mean. So like the next episode, I'm going to talk about the jobless claim. The jobless claim actually increases, but actually it's really good for the market. So means that even there are more jobless people out in the market. In that data shows compared to April, the May's data compared to April, it's actually good. The market needs that, because otherwise there'll be spiraling wages. So just kind of like hope that you can able to configure all these jargons whereby some bad news actually in the real economy is actually good news in the market. So that's all for today. Thank you very much.